Let's talk about your credit score. It's way more than just a number. In 2025, it's basically the key that can either unlock or lock away tens of thousands of dollars when you go to buy a home. So let's dive right in and uncover this powerful, kind of hidden connection between that three-digit score and what you really end up paying for a mortgage. Okay, let's just start with this number. $36,345. Now, this isn't a down payment and it's not what you'd pay for a kitchen remodel. No, this is the extra interest a homebuyer with a lower credit score could end up paying over the life of their loan compared to someone with a top-tier score. That's a huge difference.
So the big question is, where does this penalty even come from? I mean, it's not just some random number a bank pulls out of thin air. It's actually built right into the architecture of the mortgage system. And to really get it, we're going to do what you always do. We're going to follow the money.
So when you apply for a mortgage, the system looks at you and essentially assigns you a risk level. How likely are you to pay it back? And to understand the cost, you first need to see that there are basically two different ways the system prices that risk. Think of it like this. There are two main highways to get a mortgage. You've got the conventional loan highway, which is kind of run by big players like Fannie Mae and Freddie Mac. On this road, your individual risk is priced with very specific fees. Then there's the government-backed highway for FHA or VA loans. Here, the risk gets handed off to a government insurer. Two different roads and two totally different ways of calculating how much your credit is going to cost you. Now, for our purposes here, we're going to stick to that first highway, the conventional loans, because that's where this hidden penalty is calculated. We're about to go inside the black box and find the secret fee matrix that pretty much decides your fate. And here it is. It's called the Loan Level Pricing Adjustment, or just LLPA for short. This is a mandatory fee system that was put in place after the 2008 financial crisis to try and stop another meltdown. Its whole job is to precisely calculate the risk you represent as a borrower and then charge you for it. And that charge gets baked right into your loan, either as an upfront cost or as a higher interest rate for, the next 30 years. So you're probably wondering, how do they figure out my LTPA fee? Well, it really boils down to two critical things. First, your credit score, obviously. And second, your down payment. The size of your down payment determines your loan-to-value ratio. A low credit score and a small down payment, the system sees that as a double whammy of risk. Okay, now let's actually look at the matrix in action. This is where it gets really eye-opening. See that top left corner? If you have a great score, say 780, and you put 20% down, your fee is zero. Zilch. Now look at the bottom right. A borrower with a score in the low 600s and only 5% down, they get slammed with a massive 3% fee. The penalty just skyrockets. And this chart just drives that point home. It's so clear. The difference between the best case borrower and the worst case borrower is a full 3% of the entire loan amount. That visual contrast just makes the impact undeniable. Now let's translate that percentage into cold, hard cash. On a pretty standard $300,000 loan, that 3% fee is an extra $9,000 you have to come up with at closing. Or if you can't, you roll it into the loan, which means you're stuck paying a higher interest rate every single month for 30 years. That's the source of our $36,000 penalty. All right, so just when you think you've cracked the code of the LLPA, guess what? A huge change is coming in 2025 that's about to shuffle the whole deck. Here's the deal. Starting in July 2025, the government is going to let lenders use one of two different credit score models for conventional loans. They can use the classic FICO score that we all know, or they can use its competitor, VantageScore 4.0. And this kicks off a whole new game called score shopping. Lenders now have a really good reason to check both of your scores and just use whichever one is higher. Now, for you, the individual borrower, that's awesome. A higher score means a lower LPA fee. But for the whole system, it creates a brand new dynamic.
And this right here is what has analysts really concerned. By always picking the higher score, the system is pricing loans as if they're less risky, but the borrower's actual chance of defaulting hasn't changed at all. It creates this gap, what experts are calling uncompensated default risk.
So how big of a gap are we talking about? Well, the high-end estimates say this little game of score shopping could reduce the fees collected by Fannie and Freddie by up to $1.7 billion a year. That is a massive shortfall between the risk they're taking on and the money they're collecting to cover it. Okay, so with all this going on, what does it actually mean for you? Knowing about these two paths and these new rules, let's figure out what your best move is and how you can make the smartest financial decision. It's actually pretty straightforward. If you've got strong credit, we're talking a FICO score over 720, that conventional loan path is almost always going to be your cheapest option. You'll pay tiny LLP fees or none at all, and eventually you can get rid of your private mortgage insurance, which makes it way cheaper in the long run. But, and this is really key, here's the crossover point. If your credit score is under 700, the math completely flips. Those high LLPA fees on a conventional loan suddenly make it way more expensive than an FHA loan. So for this group, that government-backed highway becomes the more affordable route.
Now, there's always a catch, right? With an FHA loan, the big trade-off is the mortgage insurance. On a conventional loan, that insurance, called PMI, eventually goes away. But with an FHA loan, their version, called MIP, usually sticks around for the entire life of the loan. It's a permanent cost you really gotta factor in.
All right, that was a lot to take in, so let's boil all of this down into a simple, clear, actionable game plan you can use when you're getting ready to buy a home. Here are the 4 biggest takeaways. First, and this is the most important one, do everything you can to get that credit score to 760 or higher. That's the magic zone. Second, save up for the biggest down payment possible. Every extra dollar lowers your fees. Third, if your score is below 720, you absolutely have to get quotes for both a conventional and an FHA loan. Compare them side by side. And finally, if you're a veteran, check out a VA loan first. It is almost always your best possible option. Which really leaves us with this final big picture question. This new score shopping rule is designed to help more people get more affordable loans, which is a good thing. But as we've seen, it also pumps a whole lot of unpriced risk into the financial system. So the big question for 2025 and beyond is, will the savings for individual homebuyers be worth the potential cost to everyone else down the road? It's something we're all going to be watching very closely.